Financial Accounting Chapter 4. Introduction. Regulation is defined as a set of rules designed to control and govern conduct by authority based on this definition. Deegan has defined regulations relating to financial accounting as rules developed by an independent, authoritative body to govern the preparation of financial statements, which are accounting standards. Since decades ago, there have been arguments for and against the existence of accounting regulations. With a stance of pro-regulation, this essay will examine the reasons that financial accounting and reporting should be regulated, and the merits of accounting regulations. Legal systems. Probably there is no other factor that causes more diversity in accounting than the legal system. A country has, as it not only shapes its citizens' behavior, but it also prescribes accounting rules and regulates accounting and financial reporting. The degree to which government is involved in standard setting varies from country to country. Countries that practice common law, such as the UK and the US, have their accounting regulation in the hands of professional organizations with fewer regulations. On the other hand, countries that practice Roman or code law, e.g. France and Germany, rely on detailed rules often included in the company legislation. Enterprises. Diffusion of management accounting innovations, MAIs, has grown into substantial literature that draws attention to how compulsory regulation can fuel diffusion processes. However, relatively little is known about how MAIs interact with wider societal, regulatory processes and how this affects the adaptation of such innovations as they diffuse across organizations. This paper extends research on this topic by addressing how regulators mediate the adaptation of MAIs and how this mediation affects the use of such innovations across regulates. Examples of regulation. These are some accounting standards that are used in countries around the globe other than the US. Known as the International Financial Reporting Standards, IFRS, they set general shared accounting regulations across multiple countries and regions. The IFRS was created by the International Accounting Standards Board, IASB. This is an independent organization whose main objective is to set standards for accounting. The organization is based in London, England. These international accounting standards are specially made for multinational corporations. In addition to creating and enforcing them, this organization also interprets the accounting standards used in various countries during the preparation of financial statements. While there are countries that have adopted and adapted the GAAPs for use in their economic environment, there is a gradual, collective move towards the IFRS by many countries worldwide. The regulation of international standards. International Accounting Standards (IAS) were the first international accounting standards issued by the International Accounting Standards Committee, IASC, formed in 1973. The goal then, as it remains today, was to make it easier to compare businesses around the world, increase transparency and trust in financial reporting, and foster global trade and investment.